Welcome to our discussion on cryptocurrencies versus stocks. Is Bitcoin a commodity? In the vast universe of finance, commodities have held a significant position for centuries, being essential products for people and industries alike. In our digital age, cryptocurrencies led by Bitcoin have emerged as a new kind of asset, stirring curiosity and debate. The question we're examining today is whether Bitcoin, the trailblazer of the crypto world, can be classified as a commodity. This discussion will take us on a journey through the realm of commodities, the reasons supporting Bitcoin's classification as a commodity, and the key differences that distinguish Bitcoin from traditional stocks. We'll also delve into the intriguing concept of synthetic assets based on cryptocurrencies, a novel financial instrument that mimics the value and behavior of real-world assets or financial instruments. By the end of this exploration, we aim to shed light on these complex topics in a simple and comprehensible manner. So, buckle up for this financial voyage. Let's start by understanding what commodities are. Commodities, a term you may have come across, but what does it really mean? Let's break it down. Commodities are basic goods that can be bought and sold, their value dictated by the foundational principles of supply and demand. They're the building blocks of our world, the essential products that fuel industries and meet human needs on a daily basis. From grains to gold and oil to oranges, commodities come in all shapes and sizes. However, they all share some common characteristics. Each commodity must meet certain standardization criteria, ensuring that one unit is interchangeable with another. This principle of interchangeability, known as fungibility, is key to the functioning of the commodities market. Commodities also play a crucial role in the production of other goods. Take copper, for instance. This versatile metal is a commodity that's used in the manufacturing of a wide array of products, from electronics to construction materials. When the price of copper fluctuates, it impacts the cost of these goods, showing just how interconnected commodities are with our everyday lives. While commodities may not command the same attention as the latest tech stocks or cryptocurrencies, they quietly underpin much of our global economy. Their prices are a reflection of global trends in supply and demand and can often serve as a barometer for the health of the wider economy. So why are we talking about commodities in a video about Bitcoin? Well, it turns out that Bitcoin and cryptocurrencies in general share some intriguing similarities with commodities. That's right. The digital world of cryptocurrencies and the physical world of commodities are more closely linked than you might think. Now, let's delve into why Bitcoin is considered a commodity. You may wonder, how can Bitcoin, a digital currency, be classified as a commodity? Well, let's dive into that. In essence, a commodity is a basic good that can be bought and sold based on supply and demand. Traditionally, these commodities are tangible goods like gold, oil, or wheat. However, Bitcoin, despite being intangible, shares some critical characteristics with these traditional commodities. Just like commodities, Bitcoin is interchangeable. One Bitcoin is the same as another, much like a barrel of oil or an ounce of gold. This characteristic of interchangeability is known as fungibility and is a key aspect of any commodity. Furthermore, like commodities, the value of Bitcoin is driven by supply and demand. The more people want Bitcoin, the higher its price goes. And when demand drops, so does the price. This fluctuation is similar to how the prices of commodities like oil, gold, or wheat are determined in the markets. Now, the US Commodity Exchange Act may not explicitly list Bitcoin or other virtual currencies in its definition of commodities. However, the US Commodities Trading Future Commission, or CFTC, has classified Bitcoin as a commodity. This is a significant recognition of Bitcoin's commodity-like behavior and its increasing importance in the financial ecosystem. The CFTC's classification is not arbitrary. It's based on how Bitcoin behaves in the financial markets rather than what it physically is. In other words, Bitcoin behaves more like a commodity than a traditional currency. So, while Bitcoin may not be a commodity in the physical sense, it behaves like one in the financial world. It has the fungibility of a commodity, it's driven by supply and demand, and it's been recognized as such by a key financial regulatory body. With that said, how does Bitcoin differ from stocks? Let's explore that in the next scene. Investing in stocks and cryptocurrencies are two different ballgames, each with its own rules. Let's dive into the key differences between these two forms of investment. First off, stocks have a long and storied history. When you buy a stock, you're buying a piece of a company. You're placing your faith in the company's ability to generate profits, and in return, you might receive a portion of those profits in the form of dividends. Stocks are backed by company assets or physical money, giving them a tangible value that's grounded in the real world. On the other hand, Bitcoin is a newer form of investment. Unlike stocks, when you buy Bitcoin, you're not buying a piece of a company. There are no dividends to be had. You're buying a digital asset that exists on a decentralized ledger known as the blockchain. The value of Bitcoin is not tied to any physical assets or company profits. Instead, it's determined by supply and demand dynamics in the marketplace. Let's talk about the markets themselves. The stock market is a regulated market that operates during specific hours. It's overseen by regulatory bodies that enforce rules designed to protect investors. The stock market is also less volatile than the crypto market, thanks to these regulations and the established nature of many of the companies whose stocks are traded. The crypto market, where Bitcoin and other cryptocurrencies are traded, is a different beast. It's a young market that operates 24 hours a day, 7 days a week. It's far more volatile than the stock market, with prices that can swing wildly in a short period. This volatility can present opportunities for high returns, but it also comes with high risk. Unlike the stock market, the crypto market is less regulated, although that's changing as more and more governments around the world start to introduce crypto regulations. So as you can see, investing in stocks and Bitcoin are quite different experiences. Stocks offer a more traditional investment backed by real-world assets, while Bitcoin offers a newer, more volatile investment experience that's not tied to any company's performance. Now that we understand the differences, let's explore synthetic assets based on cryptocurrencies. Synthetic assets, a term gaining traction in the world of cryptocurrencies. But what does it mean? Well, in simple terms, synthetic assets are blockchain-based financial instruments that mimic the behavior and value of real-world assets or financial instruments. Now you might be wondering how these synthetic assets are created. This is where it gets interesting. They are crafted using complex financial derivatives and smart contracts on blockchain platforms. This is primarily done in decentralized finance, or DeFi, ecosystems. What this does is it reduces our reliance on traditional intermediaries, opening up a wider range of financial markets and assets. But, as you might have guessed, this also introduces a layer of complexity and risk, requiring a deep understanding of their workings and effects on investing strategies. Synthetic assets come in many forms, each serving a unique purpose. For instance, we have synthetic stablecoins. These mimic the value of fiat money, providing a stable value in the often volatile world of cryptocurrencies. Then there are tokenized commodities and equities. These track the price of real-world commodities or stocks, giving investors access to these markets without the need to own the physical asset or stock. We also have leveraged and inverse tokens. These are designed to amplify or counteract price changes, providing investors with more options to manage risk and potentially profit from market movements. Lastly, there are yield-bearing synthetic assets. These generate passive income through staking or lending, providing a way for investors to earn returns on their holdings. So as you can see, synthetic assets based on cryptocurrencies are a versatile and powerful tool, offering a myriad of possibilities for investors. But remember, with great power comes great responsibility. As we delve deeper into the realm of synthetic assets, it's crucial to comprehend the intricacies of these financial instruments and the potential risks associated with them. Let's wrap things up with a summary of what we've learned today. We've covered a lot of ground today, so let's recap the most important points. Firstly, we dove into the world of commodities, these essential products for people and industries that have a role to play in the financial system. They are often inputs for the production of other goods, and their pricing is determined by supply and demand. Commodities such as gold and silver have a long history of being used as a means of payment. Then we explored the intriguing concept of Bitcoin as a commodity. Despite not being included in the U.S. Commodity Exchange Act's traditional definition of commodities, entities like the U.S. Commodities Trading Future Commission have classified Bitcoin as a commodity. Why? Because it behaves like one, being interchangeable and driven by supply and demand, just like traditional commodities. We then compared Bitcoin to stocks, highlighting some key differences. While stocks are backed by company assets or physical money and operate within regulated hours, Bitcoin offers anonymous transactions and operates outside of traditional economic trends. However, both markets come with their own sets of risks and require diligent research and awareness. Finally, we delved into the realm of synthetic assets based on cryptocurrencies. These are blockchain-based financial instruments that mimic the value and behavior of real-world assets or financial instruments. They offer users access to a wider range of financial markets and assets, reducing reliance on traditional intermediaries. But remember, they also introduce complexity and risk. Thank you for joining this discussion on cryptocurrencies versus stocks. Is Bitcoin a commodity? Keep exploring, keep learning.